happen when economies reopen. And through this presentation, I've been touching on aggregate demand, and we'll get to that in a moment. We've got to consider in what we're doing from an investment side of, will there be Corona 2, 3 and 4? And we know from the Spanish flu, and we know from other outbreaks that often you get a follow-up breakout. So we're looking at that. Globally, we've got a nasty supply side and demand side recession. And I know that we haven't had 2 quarters of consecutive negative growth, but I think it's suffice to say that the people in the street are feeling the effects of recession, no matter what the numbers say. And it may be the case that we've pump primed the economy sufficiently, but that the numbers reflect, when they eventually come out, that we've avoided a recession. We'll have the March quarter numbers and then the June quarter numbers. But the impact on the people, the consumers, the wage earners, it's pretty stiff. We had a look at trading in the Australian equities market. The question is, how long will the instos stay on the sideline? And we saw what would appear to be some of the instos coming to the banks just recently, but we know from those charts that the big instos are not playing at the moment. What will happen when JobKeeper, JobSeeker and any other keeping of jobs and what have you, any other job you can get, what will happen there when that rolls off? And the government's talking about extending, refocusing and what have you, but nevertheless, we just don't know what's going to happen. And we can't predict with any certainty any of the economic numbers because we just don't know who's going to do what to who. So the second last dot point, we sort of understand our abilities to forecast, and we're well aware of the skills of others to forecast, and simply our crystal ball is currently hiding under the bed. It's terrified. And so what we've got to do is focus on near-term danger and wealth preservation, and we've taken steps to do that. It'll be an imperfect solution, but until we get some clarity, it's very difficult to give anyone any real guidance. Now, throughout this presentation, I've teased and I've given time for people to run off and get their Year 10 commerce book and to look up the term aggregate demand. That's probably got people dropping their lunch bowls and looking up on the Google what aggregate demand is. So for those who haven't got that far advanced, aggregate demand is an economic measurement of the total amount of demand for all finished goods and services produced in the economy. So what's happening out there? I guess I'll give you an insight here. So let's look at it from the US perspective. The rebound in US stocks off the March 23rd lows has been really impressive, and we've seen that in Australia, and we've talked a bit, well, we've looked at what's driving that in Australia. But looking at that rebound might be predicated on the wrong question. So what people are looking at is, well, dividends in 2 years, dividends in 3 years, oh, the virus will pass. The question, the better question, if you like, is when will aggregate demand recover to its pre-virus levels? And that's a much more difficult dilemma than asking the question, when will economies return back to work? And that's the question we keep hearing out of the media. So the real question to me and to us is, when will aggregate demand return to pre-virus levels? So there are three pieces of information that are elusive at the moment. The first one is how far down is the bottom of the economic contraction. So, you know, we think we might be at the bottom now, but what if there's another outbreak? Then the next question is, if there's going to be another leg down, how long will it be before we get to the bottom? And we have no insight into that. And then the question is, how much of the world's productive capacity will be destroyed in that contraction? i.e., at its simplest, there are businesses going to go out of business or are in, you know, in bad shape right now. Virgin Australia, will it come back? If it doesn't come back, what will be that impact? And so some analysts in the US have had a crack at trying to work that out. And so something to think about is, I'll work through some dot points I've got here. How many businesses will reopen when the coronavirus containment policies end? And don't assume for a moment because a business reopens it'll be there in 6 months. So the next question is, what happens if those businesses collapse? So based on US numbers, if only 1 in 10 of the affected companies fails after a 3-month revenue gap, then the number of firms and thus the level of GDP will be permanently reduced. And the US best estimate is that if 1 in 10 firms don't come back, that will impact GDP by about 7.5%. So if GDP is 2%, knock 7.5% off 2%. It's not negative 7.5%. Okay. If you lose 7.5% of your GDP because 1 in 10 firms don't come back, then the levels of income, employment and demand will be lower than before coronavirus by around 7.5%. Okay. And what that'll mean is you've got a pretty flat recovery, you've got flat wages growth, and that goes on for quite some time. So the final sort of point to think about aggregate demand, as opposed to when the economy reopens, is that even if the recovery in growth is a perfect V shape, and we've heard lots of talk about letter-shaped recoveries, but let's assume for a moment it's a perfect V-shape recovery in growth. That resumption, if you like, will start at the lower level. So 2% minus 7.5, and you get a straight bounce back. I don't think it will be V. I don't think any economist out there thinks it'll be a V, but if it was, you would be down 7.5%. And as I noted above, wages won't rise. Productive capacity will sit idle. And that's a big issue because a lot of cheap money has built a lot of excess supply. Okay, and that's what we're seeing in oil. Everyone's been able to drill a hole in the ground. Now we've got a mountain of oil. And it's all being drilled on cheap money. So that could be, you know, assets could be sitting there effectively idle for some time. Okay, so even if the economy growth were to jump from 2% yearly pace, which it was prior to the coronavirus, and let's assume that it bounced to an unprecedented 10% pace in the new world, that is still going to be lower than where we started 3 years ago. Okay, so if you've got a V shape, we're at 2%, bounces 10%, we're still down because we're down 7.5%. So if you think about it and you want to get into letters, it's probably more like a distorted J shape recovery than it is a V shape. And what that means, a J shape, is that from wherever we start to turn around, the economy will actually slacken, soften, whatever you want to call it, and then it'll start to accelerate. And that in itself is going to impact markets and equity market volatility. So as people look out there and all of a sudden their dreams don't come true, and the people who have invested saying, oh, well, this year's dividend's been damaged, but next year's will be all right, you'll be horrified to find out that next year's returns are probably not going to be much better. So to me, the issue is we need to be looking at and thinking about aggregate demand. It's very difficult to work that out at the moment because we don't know how much damage it is, how much damage has been done. But what we do know is that it's a more sound way of determining demand for goods and services than it is to say, when will the economy reopen? And at the moment, markets are operating on, oh, well, you know, there's a glimmer of light because the economy's starting to reopen. What it's not calculating in is the damage done. And I know that was a bit of a cook's tour of aggregate demand, but nevertheless, that is the term we need to think about. If people have got questions, then put your hand up on